Today on InvestTalk, we look at how the insurance industry will benefit from the CrowdStrike outage. We look at the catalyst for today's strong market bounce. Then we answer questions about Airbnb, American Express, CVS, and more. And then near the end, I discuss covered call ETFs and how to analyze their strategies.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point is about cybersecurity. And a few weeks ago, we had the big outage due to the CrowdStrike issues. And the CrowdStrike stock is down pretty big, right, from 400s. Now it's trading at 240. If you look at some of its competitors, they're holding up, like SentinelOne, for example. And they'll certainly gain some business here. But a lot of those names remain pretty expensive. But if you are thinking about other types of companies that could benefit from this event, it's really insurance companies. Why? Because a lot of them write cyber insurance, okay, that covers cyber attacks, data breaches, and outage incidents like this one from CrowdStrike. And it's a fast-growing space. And so this could be a tailwind leading to greater than expected growth over the coming years. Now, I'm going to name some names here. Doesn't mean you go out and buy them, but just a heads up, kind of a history of the industry and some names of where they're at. So AIG was the first back in 1997 to underwrite the very first cyber insurance policy. Now, just because they're the first mover doesn't mean that they're the largest out there. They're actually the 9th largest underwriter of cyber insurance policies out there. And it's a very small portion of their overall business. And that's kind of the case for most of these companies. It's like there's no pure plays out there where you just, this company just does cyber insurance. Okay. There's companies like Axis that represents about 6.5% of overall premium revenue, their cyber insurance business. So it's still small, but more sizable than, say, other companies that are out there. Hartford is another one. They're the 16th largest cybersecurity company, and premiums were up about 15% last year. So obviously that's going to continue to go up. Markel is another one. They tend to underwrite specialty insurance. So this is kind of a type of specialty insurance and certainly should improve their growth. Travelers is another one. They are actually the 4th largest U.S. cyber insurer with $385 million in total premiums. But they did have a drop in overall premium volumes from that business last year. And then W.R. Berkley, it's another one that's still small and growing. So these are ones to think about. I'm not saying you go buy any of these. These are definitely not a recommendation to buy these, but these are some you look into along with the rest of the insurance industry. And if you don't have, I talk about the exposure to financials, especially in an inflationary environment, tends to be pretty good. The small banks, not areas that I would be in, but these are the type of areas in the financial space that may be boring, not exciting, but you can still find growth and you can find great businesses with great profitability. 888-99-CHART, 888-992-4278 is how you get through and ask your question on today's show. So the market today was strong. You had the economic data come in a bit stronger than expected. Initial claims for unemployment actually ticked down from last week. There was a bit of a conniption fit around a multi-year high in initial claims for unemployment insurance at 250,000 last week, but it dipped to 233,000 this week, 233,000. And if you look at continuing claims for unemployment, that did tick up though. So that's what's interesting here is the market is paying attention to that headline number, but the reality is you continue to see more and more people on the unemployment rolls. So I think the market's reaction here was a bit off base. The reaction basically took the odds of a 50 basis point cut next month by the Fed from 70% down to 55%. Still the majority of the odds, but obviously less. And that's because, hey, it's showing that maybe the economy isn't as bad as that jobs number had indicated. Okay, so that was kind of the story today. What that did, well, it strengthened the dollar, weakened the yen a bit, and allowed for the yen carry trade, those that were in it, to maybe unwind a little more orderly, and just had everything go for them as opposed to against them. So that was kind of the market today. Broad-based rally. Small caps are up nearly 2.5%. Same with the broad U.S. market. Large cap growth certainly was the best. I was up over 3% on the day. But you look over the week, you still have a lot of losses. If you look at the heat map over the last week for the S&P, for example, you still have Apple down 5, Nvidia down 11, Microsoft down 4, Google down 5, Tesla down 12.5. This is all over the last week. Amazon down 12.5, Oracle down 7, Accenture down 5. So really, the strength remains health technology. That area is up, as well as consumer non-durable. So think of Procter & Gamble, Coke, etc. Those are the names that have certainly done the best. And then the telecom companies, from T-Mobile to AT&T, Verizon, those are holding up as well over the last week. So it's always important to not just look at one day. One day can kind of mean anything. So it's always interesting to see kind of what's the trend of at least the last week, especially in a volatile market like today. So that was the market. We'll get more data tomorrow, and that's about next week. It is the inflation data and whether or not that has ebbed enough to really allow the Fed to ease aggressively beyond just a 25 basis point cut, which is, as of yesterday, was almost priced in.
Hey, Mr. Justin, Bill from Philadelphia here, calling about Airbnb, ticker symbol ABNB. They just posted earnings, and the stock dropped around 14-15%, and wanted to get your thoughts if this was a good entry point around that 111, 112, 113 area. I'm looking forward to hearing your answer. Thanks for what you guys do.
All right, looking at Airbnb, I don't think I need to tell everyone what they do, but they went IPO in 2020, late 2020, early 2021. Everyone was hyped up about them. They were losing money up until 2022, and they made $4.27 last year. But they just had earnings, and it was worse than expected. Revenue was still up 11% year over year, but earnings were down 12% year over year. And analysts continue to expect that decline in earnings to continue in this current quarter. So really, it's about the demand for vacation rentals. And I've been saying this for a long time. A lot of people are chasing vacation rentals as an investment. And it can work. Not to say, it can't work, but it's risky. A lot of people look at the yield. They say, I can get 18, 20, 25%. And that's certainly true. But it's usually in good markets, good economies. But if the economy gets weaker, as it has been, then suddenly bookings dry up. And it's not as easy as it was in the past. Because go back and look in history. The history says the travel industry, which is basically what vacation rentals are, it is a cyclical business. Go talk to a hotel operator that's been in business for, 25 plus years. They'll tell you it goes up and down. And so that's what this earnings report was saying, that, hey, bookings are down. And that's why the stock has reacted like it has. And I think this was probably not a great place to be in the near term, because I think it's only going to get worse. So I don't have a buy point yet, because I don't know where the bottom of this cycle will trough at. Earnings are expected to fall 1% now this year. But guess what? Those estimates continue to come down, and it's probably going to be worse by year end. So a name that's interesting, but it's still, expensive even after this drop, because there's no growth here. Okay. So enterprise value to EBITDA is 30. Price sales 7. And so a lot of the hype still continues to come out of this thing. And I think it still has room to go. And I would want to buy it as a play on an upcycle in the economy, right? If things start to turn better as opposed to marginally get worse, that's what's happening now in the economy, then I would jump on it. So keep it on your watch list, but near term, I just don't see a good time to be in it. And this is also a time to rethink vacation rentals. If I know a lot of you out there have probably invested in some and understand that those high returns during good times oftentimes get cut dramatically and sometimes go negative when the economy struggles. Now, I hope you've been telling your friends about the InvestTalk podcast in video form over on our YouTube channel. And let's answer one of those questions that came in earlier. Jim Leahy says, thoughts on WRB. This is Berkley Corp. WR is what it sometimes goes by. And it's a boring name. It's insurance, right? But it's a name that is consistent in its profitability, consistent in its growth. And I like these type of names, okay? And it's an insurance company that underwrites commercial casualty insurance. Okay, so think of excess and surplus line insurance, workers' compensation insurance, self-insurance consulting, reinsurance, and regional commercial lines for small and medium-sized businesses. Now, that would be the big worry, is that this is for smaller companies. Maybe a lot of them struggle if the economy continues to get weaker, etc. But this is a powerful name. It just continues to go up and up. Earning return on equity 21%, very strong. I'm going to give this one a thumbs up. The technicals are fine. I have no issue with this company, WR Berkley Corp. Thanks for the call. Let's go to Art in Menlo Park, looking at Palantir Technologies. You own it or looking to buy it?
I own some, but I'm looking to add a little. But I think it's a little overvalued at this point. But I know they just had formed a partnership with Microsoft, I believe, this morning. So I was just wondering what your thoughts were as far as entry point, re-entry.
Yeah, I mean, they had earnings a few days ago. It reacted negatively, and it's bounced back on that news, like you said, bringing AI to U.S. government agencies. And that's what this is really you're betting on here, is the growth of the demand for cybersecurity efforts within the U.S. government and big data. And Palantir is, the leader there. They have a lot of great connections, and they're part of what would be the military-industrial complex, but on the cybersecurity side. And so the business is steady, right? As long as the government is spending money on cybersecurity, Palantir is going to be part of that. And but is it worth it, right? Is it worth the high multiple that you're paying, right? 42 cents a share expected earnings next year on a $29 stock. So you're talking forward-looking multiple in the 70s. That's pretty expensive, right? You're looking at price to sales, which I would say anything over 10 is a lot. It's at 28. Okay, enterprise value is 135. It's just very, 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 very expensive. I'll pay a premium for it because of the stickiness of its business, but I just don't see owning the stock at this level. It's just way too high. So I wouldn't be adding to it here. Maybe hold on to it because the technicals are fine. I don't see this reversing tomorrow or anything like that. And obviously it's some good news now, but I wouldn't be adding to it.
Okay.
Thanks.
Do you have an idea of what a good entry point would be?
$10.
Oh, okay.
There you go.
Sounds good.
No,
Thanks.
No problem. Thanks for the call. Let's go talk to Peter in Rhode Island, looking at IWN, which is the Russell 2000 Value ETF. You own it or looking to buy it?
I'm looking to buy it. So, long-time listener, first-time caller. Appreciate everything you guys do.
Of course.
I've recently decided to roll over my old 401k target-dated fund into an IRA where I have a little more control of my investment.
Yep. Good call.
I'm going to stick with Fidelity, and I've been researching some of their IRA investment options.
Uh-huh.
I don't really have the time to dedicate to researching individual stocks, so I'm looking at a combination of ETFs to build up my portfolio.
Okay.
And I was just wondering what your thoughts were on IWN.
Yeah. I mean, this is a small cap value index, and that's what you're getting exposure to. 24 basis points on expense ratio. Not bad for a small cap exposure there. So I have no issue with it, to be honest with you. I wouldn't be the whole portfolio, but you sound pretty young, and this is a good add into a mix of other assets. But this is a simple way to gain that exposure without doing a whole lot of work.
Excellent. Yeah, it would only be a percentage of the portfolio. It's not going to take up the whole thing, so that would help.
Yeah, I like it. IWN.
Excellent.
There you go.
Thank you very much.
Thanks for the call. Now let's touch a bit on new IRA rules that are coming down this year, and 401k rules. So some pretty interesting ones, actually. Now, no more RMDs for Roth 401k plans. This was always a weird one. Before now, if you contribute to a Roth 401k, you were still subject to RMDs, which made no sense, right? RMDs are there so the government can get their tax eventually, right? You put money into a traditional IRA or a 401k, you don't pay tax on it, and the RMDs are designed to, hey, eventually you need to take that money out and start paying some taxes on it. Well, for a Roth, you already paid the tax, so it never made sense. Now you no longer are required to take an RMD from a Roth 401k in line with a Roth IRA. Okay. Now, beginning in 2026, participants in 401k plans who are 50 or older and exceed the $145,000 income limit must make their catch-up contribution in a Roth account, meaning they can't just put a bunch of money into a tax-deferred account, get that write-off when they're in this high tax bracket. Okay, this doesn't affect Roth IRAs. There's still other rules for that, but you can no longer get your catch-up contribution if you make too much money in a traditional 401k. It must be in a Roth 401k. What else? Something that takes effect this year allows older spouses who's a beneficiary of an IRA owned by a younger spouse who dies to be treated if he or she were the age of the deceased spouse. So, for example, this happened to my grandfather. My grandfather's second wife, she passed. She was 10, 12 years younger, and she actually passed before him. But in this new case, he could basically assume her age and not take RMDs until she would have been 73. So that's what the new rule is. Pretty interesting. There's also reduced penalties for missing your RMD, going from 50 to 25%. Still pretty high, 25%, but lower. And you can still ask for a waiver of any penalty from the IRS. They may or may not give it to you, but you must explain yourself. Also, interest and penalties for missed RMDs from an IRA will go on before this recent rule. It's going indefinitely. But there's now a 3-year statute of limitations. So if you miss an RMD and the IRS doesn't call you out over the next 3 years, there's no penalty. Okay? And there's also a 6-year statute of limitations for excess contributions to an IRA. Same thing. If the IRS doesn't call you out within 6 years, kind of got away with it. Okay? Now, also SEP and simple IRAs. Now, SEP, for everyone out there, SEP IRAs, the contributions are made by employers, while simple IRAs can be made by both employers and employees. Well, now you can do Roth contributions as well. So there can be Roth SEPs, Roth simples, etc. So that's pretty interesting. And employer matches can now be made in a Roth 401k. Now, you do have to pay taxes on it. Okay, so if they're contributing money to a Roth, it's not like you're skirting out on that tax. Okay, you're not seeing that money in your bank account. Say it's $1,000 a year for round numbers. That's going to be $1,000 added to your adjusted gross income that you do not see, and so you'll have to pay it out of your pocket. But it's something that is available now. So this is all because of the Secure Act 2.0, and hopefully educated a few of you on some of these new rules, and maybe you can take advantage of some. Now let's go back to the InvestTalk voice bank for a question that came in earlier at 888-99-CHART.
Hey, Luke and Justin, Matt from South Florida. Wanted to talk about American Express, AXP, with the stock down about 8-9% over the last 5 days, always looking for an entry point. I like the company. I know it's been a little overpriced, but I'm not sure that the market's pricing in the fact that if the Credit Card Competition Act from Marshall and Durbin, if that does go through, I anticipate a lot of customers migrating from Chase, Citi, B of A cards, premium cards, over to Amex. That's a longer story, too much to get into, but I'm pretty confident in that last piece. If that piece of legislation happens, Amex will get a serious bump. So that aside, I'm sure that as an investor, you should not assume something like that will happen. But if that's not priced in at this price, I think it's around 231. Is it today a good deal given the recent 5-day pullback? Look forward to hearing your opinion. Thanks.
I like what you're looking at. I like your comments about the Secure Act. There are some potential tailwinds that would help American Express. Once again, don't need to get into the details, but everyone else can read up on that. But it's something to consider. And American Express historically is a very good business, very strong profitability, good management, etc. Now, business is slowing, though. Revenues last quarter were only up 10%. A year ago, they were up in the 20s. And earnings were up still 44% year over year. That was nice. But earnings are supposed to be up 21% this year, 10% next year. That's good. Some good growth. Now, the one thing that's likely to help them is that, as I said yesterday, the economy or the consumer in general is pretty strong, especially in the mid and high end. Some of the poor, lower income parts of the economy, they continue to struggle, but that's not usually where American Express is lending to. And so I like that aspect, but it was overbought and it needs this kind of refresh, but it doesn't really get good support, to be honest with you, until right around $200 per share. Now it's at $233. There's some support around $212, but really about $200 is really where I'd want to pick it up. So I'm going to give it a thumbs up there. And I like what you're looking at. I like that you're looking at good companies on weakness, but I don't think the weakness is quite over yet. I would set a buy point around that 200 level. Thanks for the call. Now, from time to time, we receive questions via the comment section on our YouTube channel, and let's get to one now. Geekiro Boss, I believe is how you say it. That's the handle. I am a software engineer, and my portfolio only has Microsoft, Amazon, and Adobe RSUs. You probably work for all three. I'm looking for your thoughts on diversifying my portfolio. Are there any ways in which I can save taxes on capital gains when selling these RSUs and buying other stocks? Thanks for the great show. Now, this would only apply if you probably have around $1 million or more in these in the stocks, which potentially you do, depending on how high I paid you are, price appreciation, etc. But a deferred sales trust is probably a way to do that. Defer those taxes, start diversifying the portfolio. And this goes for anybody who's has a business they're selling. It goes for anybody who has real estate that's highly appreciated. They don't want to take those capital gains, but they also don't want to do a 1031 exchange. Deferred sales trust, it's a great structure. You can buy life insurance policy with the proceeds and still give the money to your heirs through that life insurance, etc. So it's a really great tool. That's probably the only way to do it. It does have some expenses to set up. That's why it's usually when you only have $1 million or more in assets. But hopefully you do between Microsoft, Amazon, and Adobe. And I like what you're thinking there to try to limit the tax basis or tax hit in any given year. This can spread that out potentially as well. So I would reach out to me, set up a call, and we can discuss a little more details on that. But that'd be the only way I see to lower that tax burden, or let's say defer that tax burden and potentially lower it, as well as diversify your portfolio, which you're thinking about in a very smart way. Now, 2024 is moving fast, and proof is that we're in the warmest days of the third quarter. And yeah, we're through 7 months of the year. Summer will be over before you know it. And the big question is, has this recent volatility unnerved you? Do you feel confident in your ability to navigate these type of environments? Or do you have a handle on it? Well, It depends on your time, depends on your data, depends on your discipline. If you have those three things, you can do that. But those are hard to find. In a busy life, it's hard to find time. It's hard to find the right data to pay attention to. And then the discipline to not get caught up in headlines, chasing performance, chasing yield, right? Chasing the dividend or chasing some interest rate, and understanding how to analyze the risk and reward of the investments. Well, if you need help, I encourage you to reach out and schedule a portfolio review assessment with me via telephone or Zoom. And we can go over your situation, your risk level, and point you in the right direction. Maybe that's you just making a few tweaks on your own. Maybe that's hiring a professional like myself or somebody else. Who knows? We won't know until we do that full analysis. And we offer the same type of advice both on and off air, which is unbiased guidance, and we practice parallel investing, which means you invest right alongside our clients. So I encourage you to take advantage of that free portfolio review by heading over to InvestTalk.com.
Hey guys, this is Josh from Tampa. Thanks for everything you guys do. I'm calling today about Kinsale Capital, ticker KNSL. They're insured. They seem to have a pretty good combined ratio and are growing at a pretty good rate. My question is, they seem to be pretty overvalued, and I was just wondering if you guys think that the valuation is warranted because of the growth. If not, what would be kind of a good number to maybe get in, and what your overall thoughts of the company are? Thank you. Have a good day.
All right, looking at Kinsale Capital Group, supposed to earn $15 this year and $17 next year, trading at $467 today. So if you're based on forward-looking earnings, it's in the high 20s, high 20 multiple. That's actually not terrible for a business that is growing the way it is, to be honest with you. Its free cash flow is $915 million at an all-time high, continues to move higher, and it's a market cap of $10 billion. It's a pretty good free cash flow yield. Return on equity 35%, that's very high. And they are taking their cash flow and they're not buying back shares. So I wish they were doing that, but it's certainly doing fine. They have a very strong balance sheet and the technicals are good. So I don't mind this, right? Still a smaller, it's a mid cap, $10 billion market cap there. Pretty much no dividend, but it's a good business. There's some dividend, but it's 0.13%. It's next to nothing. But I like it. I actually kind of like it. You're paying a premium, but I don't think it's egregious based on its growth and consistency, the type of business, etc. It's boring. It's an insurance company, provides property and casualty insurance, but it does that for specialty lines typically. So I'm going to give Kinsale Capital Group a thumbs up. Now let's touch a bit on, where are we? There we go. Covered call ETFs. Covered call ETFs. They've become very popular. They've grown from $18 billion in early 2022 to $80 billion as of July. And they promise equity-like gains with bond-like income and volatility. But as I've said many times, people call about these, there is JEPI, JEPI is the JP Morgan one that is the most common actively managed ETF that's out there. Unfortunately, the returns, at least this year, are not that great. Let me pull it up. I did pull it up a minute ago. Year to date, it's only at 4.5%. We run a covered call strategy, definitely better than that. But if you look at, there are other ones like the Global X, they have a bunch of them tied to the S&P 500, the NASDAQ 100, for example. And what's interesting is that the Global X fund shed 80% of its year-to-date returns since the start of August. Pretty crazy. So a lot of people are looking at the quote-unquote juicy yield because, selling covered calls does bring some nice level of income. But as always, it's about the underlying asset. It's not that covered call strategy. It's a way to mellow out volatility, to hedge a bit on the downside. But if the downside is big because you owned companies that were drastically overvalued or, were in poor financial position, then no level of, I don't say no level, but very rarely will those covered calls do a ton for you, okay, if you're getting giant drops in those positions. And so this recent pullback is a good example of that, is that it's not about the covered call strategy itself. It's about what you're owning, the underlying positions, and that's what you have to pay attention to.
Hey, Justin and Luke. This is Carlo from Providence. I'm wondering what your thoughts would be with CBS. I have a position that I've been holding for 3 years. I'm now down 30%, and I'm wondering if I should just take the loss or maybe hold on to it. I don't think I really want to add any at this point in time. I'm wondering what your advice would be. Look forward to your answer on the program. Thank you.
Are looking at CVS, and this is a name that historically has a very good business, right? A string of drugstores, and the drugstore business is very good. But what they've done as of late is they bought, I believe it was Aetna, and they've gotten into the Medicare supplemental insurance business, and that's frankly not gone as smooth as everyone was hoped. We had owned this stock as well, but they had bad earnings back in May, and it fell and broke major support. So we moved on. And what's interesting is that it's pretty much sideways since then, and that's not a good sign. Okay, the fact that it is having trouble getting back and getting its mojo back from a technical perspective is not something that you should be excited about. And one of the reasons we sold it was the cash flow picture. So cash flow was at an all-time high in the third quarter of 2022 at $19.5 billion. And you look at its market cap right now is $72 billion. Okay. So at $20 billion roughly, that's a huge free cash flow yield. But now it's down to $8.1 billion. Now you still say, okay, that is a nice, juicy 10% free cash flow yield. The problem, though, is the debt. 122 enterprise value is 122 billion. So that means there's about 50 billion in net debt on its balance sheet. And they levered up their balance sheet to make a bunch of acquisitions. And those acquisitions, frankly, have not panned out that well. And so the worry here is that cash flow will continue to dwindle, and they will get into a debt situation that is untenable. And you look at its competitors, like Walgreens, for example. They continue to struggle under the weight of a lot of debt. And there's some headwinds around regulation on prescription drug prices, prescription drug, middlemen like CVS. And, the whole drugstore industry just continues to struggle. And we thought that they could bounce back because of the strength of their business. We thought their acquisitions were pretty good. But a lot of times it's about execution and timing. And I think in both instances, they just have not come through to make those acquisitions justifiable. And when things struggle like this, you have to pay attention to the chart. And the chart simply broke the technicals. And no matter what, you might look at it and you say, oh, it's paying a 4.6% dividend yield. But underneath the surface, things are looking sicker than they were, a year or two ago. A lot sicker. And so that's why we moved on. We just had no confidence that things were going to turn around in the near term. And there's something called the sunk cost fallacy. And a lot of people don't understand that. They don't understand that, you bought it. It's a sunk cost. You lost. But that capital can be utilized better elsewhere if the business is not going to turn around anytime soon. And we're just not seeing any life there. And so there's more risk to the downside at this point that things will continue to unravel versus, get back to even close to COVID level type of business. And so I would sell it, I'd move on, take your losses, and redeploy that capital into something that, has good business momentum. Where CVS, it just has negative business momentum, and I'm not seeing a light at the end of the tunnel. Well, that about does it. I'm Justin Klein. This completes another Invest Talk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And head over to our YouTube channel and check us out in video form. Search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.